Hello and welcome to Mastering Finance with Dean Tellone. I'm Dean Tellone, and thank you for joining me for episode 15, our season 1 finale. Today, we're casting our eyes forward to the future of financial services. In this special episode, we'll explore the most exciting innovations and trends reshaping finance for both everyday consumers and big institutions. No boring lectures here. My goal is to give you an insightful, engaging overview of where finance is headed in plain English. Over this season, we've covered a range of financial topics. Now, in our capstone episode, we'll focus on how financial services are evolving and what to watch in the coming years. From the explosion of Fintech apps on your phone, to artificial intelligence making lending decisions, to blockchain quietly upgrading the pipes of the banking system, there's a lot happening. We'll break it down into key segments: core trends driving change, real-world applications showing those trends in action, the challenges ahead we need to navigate, and finally, a forward-looking wrap-up to conclude Season 1. Without further ado, let's dive into the core trends that are transforming finance as we know it. Core trends. In this segment, I'll walk through several core innovation areas that are shaping the future of financial services. These include the expansion of Fintech and digital banking, the rise of AI in finance, the influence of blockchain technology, the growth of robo-advisors, the emergence of embedded finance, the push for open banking, and the critical focus on cybersecurity and digital identity. Let's explore each trend and why it matters. Fintech expansion, neobanks, and digital payments. One of the most visible changes in finance is the Fintech revolution, a wave of technology-driven financial companies offering everything from banking to payments, often with a mobile-first approach. Take neobanks, for example. These are digital-only banks with no physical branches, letting you manage accounts entirely through an app. They've gone from niche to mainstream. As of 2023, roughly 1.1 billion people worldwide use neobanks, a number that's been growing at double-digit rates each year. In some countries, adoption is astonishing. For instance, about 43% of Brazilians are now using neobanks as their bank, highlighting how emerging markets are embracing digital finance. Why are these new fintech players so popular? In short, convenience and inclusivity. All you need is a smartphone to access services that once meant a trip to a bank. Opening an account can take minutes, and apps provide easy tools for budgeting, spending alerts, and more. Fintech firms are also pushing into peer-to-peer payments. If you've ever split a dinner bill using Venmo, Cash App, or Zelle, you know how effortless P2P mobile payments can be. These services have exploded in usage. To give a sense of scale, Venmo handled around $270 billion in transactions in 2023, showing how normal app-based payments have become for millions of people. Fintech expansion isn't just happening in wealthy countries. It's also a powerful force for financial inclusion. In regions where many were unbanked, without access to traditional banks, mobile money and digital finance are filling the gap. In fact, by 2024, the number of mobile money accounts worldwide surpassed 2 billion, meaning billions of people can now store and send money digitally, often via phone services, even if they never had a bank account before. This is transformative. A farmer or small shop owner in a developing country can now save money securely or receive payments using just a basic mobile phone. All of this fintech growth has pressured traditional banks to step up their digital game as well. Almost every major bank now offers robust mobile banking apps and online services to keep up with customer expectations set by fintech innovators. Interestingly, financial inclusion is improving as these services spread, yet challenges remain. About 1.4 billion adults globally are still unbanked. Fintech firms and banks alike see an opportunity to reach this population through affordable app-based services. In summary, Fintech expansion from neobanks to P2P payment apps is redefining banking convenience and accessibility. Consumers are getting more choices and often lower fees, while incumbents are being forced to innovate. This trend ultimately means a more open, competitive financial landscape that caters to a digital lifestyle. AI in finance, personalization, underwriting, and fraud detection. Another game-changing trend is the growing use of artificial intelligence, AI in finance. We're talking about advanced algorithms and machine learning models that can mimic human decision-making or better, all at electronic speed. AI in finance might sound abstract, but its impact is very concrete. It's powering everything from the budgeting app on your phone to the fraud detection systems guarding your credit cards. On the consumer side, AI is enabling personal finance apps and digital assistants that can analyze your spending patterns and help you make smarter decisions. For example, some apps now automatically categorize your expenses, alert you if you're overspending, and even use AI chatbots to coach you towards your savings goals. It's like having a financial advisor in your pocket, albeit a robotic one. AI can crunch your data and compare it to others to suggest, say, you spent more on dining out this month than people with similar income. Here's how you could save. These insights were hard to get in the past without a personal accountant. Now they're increasingly available to anyone. Banks and lenders are also leveraging AI for underwriting, that is, deciding who gets approved for loans or credit and at what interest rate. Traditionally, underwriting relied on simple rules like credit scores and income thresholds. AI allows a more nuanced analysis of creditworthiness, sometimes incorporating hundreds of data points, education, payment history, even how you fill out a form, to predict risk. The promise is that AI-driven underwriting can expand access to credit while managing risk better, and there are signs it works. One AI lending platform found that using machine learning models let credit unions approve 43% more borrowers than they could with traditional credit score models, all with low default rates. In other words, AI can uncover hidden good borrowers that old methods might miss, offering loans to more people at fair rates. That's a win for both consumers and lenders. Perhaps the biggest impact of AI in finance is in fraud detection and security. Financial fraud, whether it's credit card fraud, identity theft, or fraudulent transactions, is a huge cost and concern. AI is exceptionally good at spotting patterns and anomalies in vast data sets, which is exactly what's needed to flag fraudulent transactions in real time. Modern fraud detection systems use machine learning to analyze millions of transactions and account logins and automatically block those that look suspicious. This happens in fractions of a second. According to studies, AI-driven systems have made fraud detection both cheaper and more accurate. One analysis found that AI can cut fraud detection costs by about 30% and improve detection accuracy by over 50% compared to traditional methods. For consumers, this means more fraudulent charges get stopped before they affect you, and you get fewer annoying false alarms where a legitimate purchase is wrongly declined. AI is also enhancing security through better identity verification. Think facial recognition, or analyzing your typing patterns to ensure it's really you logging in. And in investment management, AI algorithms, including the much discussed robo-advisors, which we'll cover in a moment, are optimizing portfolios and even trading automatically. To put it simply, AI is becoming the intelligent engine inside many financial services. It brings personalization, tailoring advice or offers to you, efficiency, automating tasks like reviewing loan applications, and security, quickly detecting fraud or risks. We're still in early days, but the progress so far suggests that as AI models get more advanced, we'll see finance become even more automated and data-driven, hopefully leading to better outcomes for customers like lower fees, faster service, and fewer errors. Of course, AI's growth also raises questions around transparency and fairness. We'll talk about those challenges later, but there's no doubt it's one of the core trends revolutionizing finance right now. Blockchain's influence. Upgrading transactions and infrastructure. You can't discuss financial innovation these days without mentioning blockchain, the technology underpinning cryptocurrencies, which is now being adapted to improve mainstream finance infrastructure. At its heart, blockchain is a secure, distributed ledger. Imagine a database spread across many computers that all verify and record transactions transparently. This tech is enabling new ways to exchange value more efficiently, and banks and institutions have taken notice in a big way. In the public eye, blockchain is often associated with Bitcoin or crypto trading mania. But beyond cryptocurrencies, the technology itself has very practical uses in banking, payments, and record keeping. Financial industry leaders have moved from experimenting with blockchain to actually implementing it for certain tasks. In fact, 85% of financial executives say that blockchain technology significantly improves transaction transparency and reduces fraud risk. The reason? Blockchain creates an immutable, tamper-proof log of transactions that all authorized parties can see. That means, for example, two banks can directly share and verify transaction records without needing to reconcile separate databases, reducing errors and the chance of fraud. It's like having a jointly visible spreadsheet that updates in real time and no one can secretly alter, a single source of truth. One big area blockchain is impacting is international money transfers and cross-border transactions. Traditionally, sending money across countries is slow, often taking days, and incurs multiple fees through intermediary banks, the old SWIFT network. Blockchain-based payment networks can streamline this by enabling near-instant settlement between banks. A real-world example. Global banks like HSBC and Standard Chartered have adopted blockchain platforms for foreign exchange and trade finance transactions, creating traceable, transparent records for international deals. HSBC reported that using blockchain in its Forex processes cut transaction processing times by 40%, saving them millions in costs. That's a massive efficiency gain. What used to take days can potentially happen in minutes, with far less paperwork. Another use case is in the settlement of trades and securities. Stock exchanges and clearinghouses are exploring blockchain to speed up trade settlement, which currently takes 2 days in many markets. By using a shared ledger, the ownership of stocks or bonds could conceivably be transferred and settled almost instantly after a trade, rather than waiting for all parties to reconcile records. This could reduce counterparty risk and free up capital more quickly. There are pilot projects already where a portion of stock trades are being settled via blockchain systems in parallel with legacy systems. Blockchain is also driving innovation through smart contracts, essentially self-executing agreements coded on the blockchain. These can automate complex financial transactions and agreements. For example, in syndicated loans or insurance claims, a smart contract can automatically enforce terms, pay out funds when conditions are met, without manual intervention, which can drastically cut down processing times. One study noted that smart contracts cut certain loan settlement times from 19 days to 2 days in trials. That's a huge improvement in efficiency and customer experience. It's worth noting we're not delving into central bank digital currencies, CBDCs, here, as that's a whole topic on its own, and we'll set it aside. But even excluding CBDCs, Blockchain is influencing financial infrastructure by making it more decentralized and secure. Banks, payment companies, and even stock exchanges are now collaborating in blockchain consortia to set standards and build new systems. According to recent surveys, roughly 3/4 of big financial institutions now consider blockchain a strategic priority, a remarkable shift from a few years ago when many were skeptical. In summary, blockchain technology is moving from buzzword to backbone. It's being used behind the scenes to speed up transactions, improve transparency, and reduce costs in various financial services. Most consumers might not directly interact with blockchain. You may not even realize when your bank uses it, but over time it can lead to faster, cheaper, and safer banking experiences. As this trend continues, we can expect the financial system to gradually transform, much like upgrading from an old, slow operating system to a faster, more secure one that runs 24/7 with fewer glitches. It's an exciting space to watch, as innovations here could underpin many of the other services we use. Robo-advisors and digital wealth management. Managing investments and wealth is also evolving thanks to technology. A notable trend in the past decade has been the rise of robo-advisors. These are automated investment platforms that use algorithms to manage your portfolio, typically at a fraction of the cost of a human financial advisor. If you've heard of services like Betterment or Wealthfront, or even offerings from traditional firms like Vanguard Digital Advisor, those are robo-advisors. They ask you a few questions about your goals and risk tolerance, then use software to invest your money in a diversified portfolio, often using index funds or ETFs. They continuously rebalance and optimize that portfolio for you. All of this happens with minimal human intervention, which means fees are usually much lower, sometimes no management fee at all, or something like 0.25% per year, compared to the approximately 1% that human advisors often charge. The convenience and low cost of robo-advisors have attracted many investors, especially younger folks and those with smaller balances who previously might not have had access to quality advice. As a result, robo-advisory services have grown tremendously. To give you a sense, in the United States, assets under management by robo-advisors have soared from around $200 billion in 2018 to roughly $1.1 trillion by 2024. That's a 400% increase in just 6 years. And globally, the number is even larger and still climbing. This means a significant chunk of investment dollars are now being handled by algorithms rather than traditional stockbrokers or investment managers. What do robo-advisors do differently? For one, they make investing simple for the user. Often you can set up an account on your phone with a few taps, and the robo-advisor will automatically allocate your money across, say, a mix of US stocks, international stocks, bonds, etc., based on your preferences. They also often provide nice visual dashboards, retirement planning tools, and tax-efficient strategies like automated tax loss harvesting that were once available mostly to wealthier clients. In short, robo-advisors have democratized access to investing advice. You don't need a six-figure portfolio to get a tailored investment plan now. For institutions, digital wealth management is also a big deal. Traditional advisory firms are incorporating robo-features to serve clients more efficiently. Many are adopting a hybrid model. Basic portfolio management is automated, while human advisors focus on higher-level planning and hand-holding where needed. This allows them to serve more clients at scale. Additionally, banks are launching their own robo-advisor platforms to keep customers in-house. The trend here is that algorithms are handling more of the heavy lifting in wealth management. This can lower costs and often yields performance similar to human-managed portfolios, especially for standard strategies like investing in index funds. However, human judgment isn't disappearing. It's just being reserved for more complex decisions or personalized advice beyond the raw portfolio mix. From a consumer perspective, it's great to have these options. For example, a young professional just starting to invest can begin with a robo-advisor with as little as $100 and get a globally diversified portfolio in minutes. As their needs grow more complex, they might seek a human advisor. The robo-advisor trend also pressures the financial industry to be more transparent about fees and to adopt the user-friendly digital experiences that people now expect. In the future, we might see robo-advisors integrating more AI to further personalize advice. For instance, adjusting your financial plan if you buy a house or if market conditions change. We might also see more offerings in areas like automated retirement income planning, or even AI-driven stock picking, though that gets trickier. For now, robo-advisors are firmly established as a key part of the wealth management landscape, and their growth is a clear sign of how technology is making investing more accessible. Embedded finance and banking as a service. You may have noticed financial services popping up in places you wouldn't traditionally expect, like getting a loan offer from a payments app or a debit card from a retail store's app. This is the world of embedded finance and banking as a service, BaaS, a trend that's blurring the lines between banks and non-banks. Essentially, embedded finance means non-financial companies, think tech firms, retailers, ride-sharing apps, etc., are integrating financial products directly into their platforms. They often do this by partnering with licensed banks or fintech providers behind the scenes. That's where banking as a service comes in, as those licensed institutions offer their services via APIs to the front-end companies. Why is this happening? Because it creates a smoother experience for customers and opens new revenue streams for companies. For example, consider a ride-sharing app that pays its drivers. Instead of sending earnings to the driver's bank, the app might offer its own wallet or debit card where drivers can instantly receive their funds and even do their banking. Or think of an e-commerce platform like Shopify. It now provides Shopify Balance, which gives online store owners a business bank account and card integrated right into the Shopify platform. Merchants can manage their sales revenue and expenses without ever leaving the Shopify dashboard. No need to separately log into a bank. That's embedded finance in action. Banking features delivered in a context that's convenient for the user. Another familiar example is the Apple Card and Apple's new savings account. Apple is a tech company, not a bank, but they partnered with Goldman Sachs, which provides the actual banking backend, to offer financial products embedded in the Apple ecosystem. Earlier this year, Apple launched a high-yield savings account inside Apple Wallet, so iPhone users can save money easily. The result? It attracted over $10 billion in deposits within just a few months of launch. That's an astounding figure that shows the power of a seamless user experience. Millions of people trusted a savings account because it was integrated with a product they use daily, their iPhone. Even though the account itself is backed by a traditional bank, FDIC insured via Goldman Sachs. This illustrates how embedded finance can rapidly scale when done right. The growth potential for embedded finance is massive. One report projects that the embedded finance market could reach $7.2 trillion globally by 2030. Financial services are basically becoming Lego blocks that any company can plug into their offerings. We see buy now, pay later payment plans offered at online checkouts. That's a form of lending embedded in e-commerce. Airlines or hotels offering their own credit cards and rewards apps, and even tech companies enabling crypto trading in their apps. For consumers, this often means more choices and convenience. You can get loans, insurance, or payment services at the point of need instantly. For companies, it means they can deepen customer engagement and find new revenue in financial services without having to become a regulated bank themselves, since a BaaS partner handles that part. However, with opportunity comes competition. Traditional banks are not sitting idle. Many are positioning themselves as the behind-the-scenes service providers in this model. Instead of exclusively pushing their own branded products, some banks are happy to power the financial services of others via APIs. This trend is sometimes called white label banking. It's a shift in thinking. A bank might say, "We don't care if the customer sees our name or not, as long as we're handling the accounts or transactions under the hood." For instance, a small fintech app might offer checking accounts to its users, but those accounts are actually issued and managed by, say, Wells Fargo or another bank through an API. The user's relationship is with the app, yet a bank ensures compliance and holds the deposits. Embedded finance is at the forefront of fintech innovation because it's redefining how and where people access financial services. Instead of going through a bank for everything, your finances are becoming woven into the fabric of other daily activities. Shopping, traveling, social media, yes, even apps like WhatsApp and Snapchat have toyed with payments inside their platforms. It's likely that this trend will continue to grow. We may reach a point where every company is a fintech company to some degree, offering financial tools as part of their customer experience. From a consumer perspective, it will be important to stay mindful of who is actually providing the service, since trust and safety matter. But overall, this opens up a much more diverse financial ecosystem. To sum up, embedded finance means you might get your financial services from unexpected places, your favorite apps and brands, in a way that feels natural and integrated. It's convenient and often tailored to specific needs, like financing a purchase right at checkout, or managing business cash flow in your e-commerce app. This trend is breaking the monopoly of banks on financial offerings and fostering a new era of collaboration between fintechs, banks, and consumer companies. Keep an eye out for financial features showing up in the apps and services you already use. Chances are you'll be using embedded finance sooner than you think, if you aren't already. Open banking and data sharing for personalized services. Hand in hand with embedded finance is the concept of open banking, a trend built on the idea that your financial data belongs to you, and you should be able to securely share it with other services to get better, more personalized products. In traditional banking, your account information was siloed in your bank's systems. Open banking breaks down those silos by requiring banks to provide secure digital access, usually through APIs, application programming interfaces, to customer data, if the customer consents. This allows third-party fintech apps to integrate with your bank data. Why is that a big deal? Because it enables a whole ecosystem of innovative services that can analyze your finances holistically. Imagine aggregating all your bank accounts, credit cards, and investments from different institutions into one dashboard that gives you a 360-degree view of your financial life. That's possible because of open banking. Or consider a budgeting app that connects to your checking account and credit card in real time, automatically tracking your spending and giving you insights. Or perhaps a price comparison service that, with your permission, scans your bank transactions and suggests a cheaper loan or a better insurance deal tailored to your actual history. All these personalized services rely on being able to access financial data across providers, which is exactly what open banking facilitates, with strong security measures in place. This trend started in regions like the UK and EU a few years ago, where regulators mandated banks to open up via PSD2, the Second Payment Services Directive in Europe. It has since spread globally, with many countries adopting or considering open banking frameworks. Data sharing, with customer consent, is becoming more common even in places without formal regulation, driven by market demand. For example, in the US, while not yet mandated by law, many banks and fintechs work with aggregators, like Plaid, to allow customers to connect their accounts to third-party apps. The result has been an explosion of fintech innovation. Customers can essentially build their own bank by picking apps that specialize in different things. One for budgeting, one for investments, one for loans, and linking their data to get a unified experience. Open banking is the plumbing that makes this interoperability possible. It's also paving the way for better financial deals. If you can easily share your transaction history with a new lender, for instance, that lender might offer you a more personalized interest rate on a loan because they have a richer picture of your finances, not just a credit score. Similarly, banks themselves can benefit by accessing data from other institutions to offer you services. It encourages competition and customization. Adoption of open banking is steadily rising. In the UK, which is one of the pioneers, open banking just hit a major milestone. Over 10 million consumers and small businesses are now regularly using open banking services. That's a significant portion of the population leveraging fintech apps connected to their bank accounts. And in many other markets, the number of users is growing every month as people discover the convenience. One analysis found that about 14% of digitally active banking customers were using open banking by early 2024, a figure that has been climbing as awareness grows. Banks, too, are increasingly viewing open banking not as a threat, but as an opportunity. A survey shows a majority of financial institutions consider open banking a high priority for innovation. What does open banking enable in practical terms? Let's paint a picture. Suppose you have accounts at two different banks, a mortgage with a lender, and an investment account. In the past, keeping track of all that meant logging into multiple websites and manually consolidating info. Now, you could use an app that pulls data from all sources with your permission and presents a cohesive dashboard. That app could analyze your cash flow and alert you that you could save money by refinancing your mortgage, or that you're paying above average fees on your investment account. If you decide to act, you could then share your data with a new provider to streamline the application. No need to fax pay stubs. The data can validate your income, etc. In some countries, open banking even allows payments initiation, meaning a third-party app can let you pay directly from your bank, bypassing card networks and their fees. This has big implications for e-commerce and payments competition. The key point is personalization and choice. Open banking puts the customer in control of their data and finances. It breaks the monopoly of any single institution over information, which fosters competition. Consumers can mix and match services to suit their needs and switch providers more easily if a better offer comes along. That's why it's often said to be a win-win. It can improve customer outcomes and also push financial firms to innovate and collaborate. Of course, data security and privacy are paramount here. Open banking systems use robust security protocols, often requiring strong customer authentication for any data access and permissions that can be revoked at any time. The idea is that sharing is always explicit and controlled by the user. As the ecosystem matures, we'll likely see even broader data sharing under what's being called open finance. Not just bank accounts, but also things like your investment data, insurance, utilities, etc., all interoperable to provide a truly personalized financial experience. For now, open banking is already changing how we interact with our finances, even if you don't realize it. If you've ever connected a financial app to your bank account by logging in through the app, you were taking advantage of open banking protocols. Expect this trend to continue growing, leading to smarter services that help people make the most of their money through data-driven insights and seamless connectivity. Cybersecurity and digital identity protection in a tech-driven world. With great digital innovation comes great responsibility. to protect the system and its users. As finance goes increasingly online and mobile, cybersecurity and digital identity protection have become absolutely critical. We've seen high-profile data breaches and hacking attempts on financial institutions, and the risks only intensify as more of our financial lives move into the cloud. The future of financial services will depend heavily on staying a step ahead of cyber threats and ensuring that customers' identities and data remain safe. Consider the stakes. Financial institutions hold extremely sensitive personal and financial information, and their services deal with moving real money. That makes them prime targets for cyber criminals. Fraudsters are constantly finding new ways to steal credentials, take over accounts, or trick people into sending money. The cost of cybercrime and fraud is enormous. In the United States alone, consumers reported losing over $10 billion to fraud in 2023, the highest on record, and a significant chunk of that involves online scams and identity theft. In fact, one study estimated identity fraud cost Americans $43 billion in 2023. These numbers are staggering and underscore why cybersecurity isn't optional. It's foundational to the future of finance. So, what trends are we seeing in cybersecurity and digital identity protection? First, financial institutions are investing like never before in this area. The global banking cybersecurity market was valued around $74 billion a year in 2022 and is projected to nearly quadruple to about $282 billion by 2032. This includes spending on advanced security software, hiring skilled security experts, and building secure IT infrastructure. Banks are also working closely with governments and regulators to bolster the overall resilience of the financial system through routine security audits, information sharing about threats, etc. On the technology front, a lot of cutting-edge tools are being deployed. AI and machine learning, which we talked about earlier, are being used to detect and respond to threats in real time. For example, banks employ AI systems to monitor login patterns. If something deviates from your usual behavior, like an unusual location or device, it might flag the login or require extra verification. Similarly, AI models scan transaction data to spot patterns that look like fraud or money laundering, catching illicit activity faster. Biometrics are increasingly used for identity verification. Many banking apps let you log in with your fingerprint or face scan now. These measures make it much harder for someone to hack into your account, since a password alone is no longer enough. This brings us to digital identity protection. Verifying that a person is who they claim to be, and doing so digitally and seamlessly, is a huge focus. We're moving toward a world of multi-factor authentication. Something you know, something you have, something you are. One factor is your password, something you know. Another might be a one-time code texted to your phone or generated by an authenticator app, something you have. Increasingly, the third factor is biometric, your face or fingerprint, something you are. Using multiple factors dramatically improves security. In many countries, banks and payment services have already implemented two-factor or multi-factor authentication by default for risky transactions or new device logins. This will continue to become standard everywhere. Beyond that, the industry is exploring digital identity frameworks where your identity can be verified by a trusted source, like your bank or government ID system, and then reused easily across services without you having to expose more data than necessary. Think of it as a digital passport. You prove your identity once, then you can share a cryptographic proof of that with others instead of, say, scanning and emailing your ID documents, which can be intercepted. Blockchain technology is even being tested in this area to create decentralized, tamper-proof identity records that you control. Cybersecurity isn't just about external hackers. It's also about safeguarding data privacy. With open banking and data sharing, ensuring that only the right people and apps have access to your data, and only for the right purposes, is vital. Consent management, encryption, and audit trails are being strengthened so that if you share your financial data with a fintech app, you and your bank know exactly what's being accessed and can revoke access easily. We also have to consider the human element. Many breaches occur not from cutting-edge hacks, but from phishing, essentially conning someone into giving away their password or clicking a malicious link. So, another trend in cybersecurity is actually education and awareness. Financial institutions are investing in customer education, sending alerts about common scams, and designing user interfaces that help people spot fraud. For example, some banking apps will now warn you if you're about to transfer money to someone new, especially if it's a large amount, with a reminder to be sure this isn't in response to an unsolicited call or message, because scams often pressure people into making hurried payments. In summary, as financial services become more tech-driven, security and trust are the bedrock. All the innovation in the world means nothing if customers lose confidence that their money or data is safe. The good news is that the industry is well aware of this and is continuously fortifying defenses. This includes adopting the latest tech tools, AI, biometrics, encryption, collaborating across institutions to tackle threats, and even preparing for future challenges like quantum computing, which could one day break current encryption. Banks are already researching quantum-resistant encryption algorithms to stay ahead. For consumers, the takeaway is that the future of finance will likely be both more convenient and more secure. But we all have a role to play by practicing good security hygiene, using strong, unique passwords, enabling two-factor authentication, staying informed about scams. Financial innovation and cybersecurity must evolve hand in hand, and that synergy is very much a trend to watch. Real-world applications. We've talked about a lot of trends and technologies. Now let's bring it down to earth and look at how these innovations are actually showing up in our daily financial lives and in the strategies of financial institutions. This section is all about bridging the theory with practice. How are consumers using these new services? How are banks and companies implementing these innovations? By exploring real-world applications, we'll see more clearly what the future of financial services looks like on the ground. For consumers, a new financial lifestyle. From a consumer's perspective, the changes we discussed are making everyday financial tasks more seamless than ever. Many of you might already be experiencing this new wave of financial services without fanfare. It just feels like things got a bit easier or faster. Let's consider a day in the life of a financially savvy consumer in this new era. Morning, you grab coffee and pay with a tap of your phone. Digital wallet payments have become ubiquitous. Your banking app immediately updates, categorizing that spend as coffee in your monthly budget. It might even nudge you. You're close to exceeding your coffee budget for the month. An AI-driven reminder gleaned from your spending patterns last month. During your commute, you check your personal finance app. All your accounts from different banks are aggregated in one place thanks to open banking data sharing. You notice your savings account at Bank A has a lower interest rate than an offer you saw advertised by Bank B. With a few taps, you securely share your account history with Bank B through the app, and voila, you initiate opening a new high-yield savings account. The identity verification is instant because the app used your verified digital ID tied to your phone, no cumbersome paperwork needed. Afternoon, you're shopping online for a new gadget. At checkout, instead of your credit card, you see an option to buy now, pay later, offered right there on the retailer's site, an example of embedded finance. You decide to split the payment into 4 installments with 0 interest. This service is provided by a Fintech that did a quick AI-driven risk check, maybe using some data you've shared or a soft credit pull, and approved you on the fly. The experience was smooth and fully integrated into the shopping process. Evening. You think about your investment goals. You open your robo-advisor app. It shows your portfolio performance for the month and notes, for example, you're on track for retirement at 67. Consider increasing your monthly contribution by $50 to reach your goal by 65. This insight is automatically generated based on market projections and your personal goals. You adjust the contribution with a swipe. No need to call a broker or read through dense prospectuses. The robo-advisor has it handled, and it even rebalanced your portfolio today without you knowing, selling a bit of an overperforming stock fund to buy a bond fund to maintain your target allocation. Night, you receive an alert from your credit card about a potentially fraudulent transaction, except the system already flagged and blocked it. You glance at the alert and confirm in one tap that you did not try to spend $500 at a store in a foreign country. The card issuer, with its AI security system, will issue you a new virtual card number immediately. You add the new card to your mobile wallet and you're done. Crisis averted, all in a few minutes from the comfort of home. This hypothetical day illustrates how these innovations come together to create a new financial lifestyle. Consumers enjoy unprecedented convenience, instant payments, personalized advice, on-demand credit, and one-stop views of their finances. Tasks that used to be tedious, budgeting, moving money between accounts, applying for credit, are becoming streamlined or even automated. Personalization is key. Services adapt to the individual's needs. For example, because of open banking, a Fintech app might notice you consistently pay too much for a subscription and negotiate a better deal for you, or an insurance app might proactively offer you coverage exactly fitting your profile at a lower rate by analyzing your data with permission. These are real things starting to happen. Another important real-world impact is financial inclusion and empowerment. Think about people who previously found banking inconvenient or inaccessible. Maybe those in rural areas without many branches, or younger people who feel intimidated walking into a bank. With mobile-first fintech services, geography and traditional norms matter less. For instance, in developing countries, we mentioned that mobile money accounts have exploded to 2 billion. This means a woman in a remote village can now safely save money and even get a microloan through her phone, something that was nearly impossible before if the nearest bank was miles away. In developed markets, a teenager can start investing with just $5 via a micro-investing app, learning good habits early. These are empowering developments. Real-world example. During the pandemic, digital payments and accounts helped distribute aid to people much faster in some cases, precisely because fintech infrastructure was in place where banking was weaker. Let's also not forget the cost savings and speed benefits. Real-time payments mean no waiting for paychecks to clear. Some employers now offer earned wage access, letting employees withdraw a portion of their earned salary before payday, facilitated by fintech apps. Peer-to-peer payment apps saved us billions in fees that we might have paid for things like wire transfers or cash withdrawals. And when competition increases, say between a traditional bank and a neobank, consumers often get better fees or interest rates as a result. One concrete example on cost: international remittances. Sending money abroad to family used to be quite expensive. Fees could be 5 to 10%. Now, fintech startups using blockchain or clever routing have slashed some of those fees, so more money gets to the recipients. A service like TransferWise, now Wise, leverages local bank accounts and smart tech to make transfers cheaper and almost as quick as a domestic transfer. That's a real-world improvement many families feel in their wallets. All told, the consumer experience is becoming one of banking without noticing. Financial services are blending into our daily routines and the apps we already use. The future might see your smart fridge negotiating grocery payments or your car's computer shopping for the best auto insurance on renewal. Who knows? It might sound fanciful, but the building blocks are being laid today with these innovations. As consumers, staying informed and taking advantage of these new tools can help us manage our money better with less effort. For institutions, transformation and collaboration. Now, what about the perspective of banks, financial institutions, and businesses? How are they adapting to and leveraging these trends? The answer is a mix of transformation and collaboration. Traditional banks, for instance, have recognized that to stay relevant, they must innovate, if not by themselves, then through partnerships. The smart players are embracing the motto, if you can't beat them, join them, or maybe buy them. Digital transformation. Most established banks have been undergoing digital transformation programs. This includes upgrading core banking systems. Some are decades old, and replacing them is like open heart surgery for a bank. Complex, but increasingly necessary to support real-time services. Moving to cloud infrastructure for scalability and implementing analytics and AI across their operations. Banks are essentially trying to become more like tech companies in how they operate. You might have noticed that your bank's app now updates with new features more frequently. That's a sign they've adopted a more agile, software-driven approach. Internally, banks are automating many back-office processes with AI, for example, AI document processing to handle mortgage applications faster, or robotic process automation to handle routine customer service queries. All this makes them more efficient and able to deliver the kind of instant service customers expect. Fintech partnerships. Instead of viewing fintech startups solely as competitors, many banks now see them as potential collaborators. The term co-opetition, cooperative competition, is often used. A large bank might partner with a fintech that has a cool budgeting tool, integrating it into the bank's app to provide a better experience without having to develop it from scratch. Or banks might use a fintech's technology white-labeled for their own operations. For example, some community banks in the US offer very user-friendly digital accounts by essentially renting a ready-made tech platform from fintech providers. Similarly, we talked about banking as a service, banks providing the regulated backbone for fintech and brand apps. This trend has banks thinking differently about their role. They might not always own the direct customer relationship in the future. Sometimes they'll be the unseen engine behind someone else's interface, and that could be okay, as long as it's a sustainable business model for them. Regulatory compliance via tech. Institutions are also applying innovations to meet regulatory requirements more effectively, a field dubbed RegTech, regulatory technology. For example, anti-money laundering, AML, rules require banks to monitor transactions for suspicious activity. AI helps them do this more accurately, reducing false alarms. Blockchain's transparency can help with compliance auditing. Recall we noted that about 40% of North American banks have invested in blockchain-based compliance solutions to streamline reporting and cut admin costs. So, the innovation isn't just customer-facing, it's improving the plumbing and oversight too. Rethinking branches and physical presence. As consumers shift to digital channels, banks are rethinking the role of physical branches. Many are closing or downsizing branches, or transforming them into advisory centers rather than transaction hubs. The branch of the future might be a smaller space where you video conference with a specialist or attend a financial education workshop rather than stand in line to deposit a check, because who deposits physical checks anymore? Mobile deposit took care of that. This is a real shift. It cuts costs for banks and aligns with customer behavior. However, It also means banks must ensure their digital channels can handle everything smoothly. Interestingly, even some fintechs that had zero branches are experimenting with physical presence for branding or to serve certain needs, so the future likely has a mix of both, but heavily weighted toward digital. New services and revenue models. Financial institutions are also leveraging technology to offer new kinds of services. For example, some banks have launched digital investment platforms, their own robo-advisors, to complement checking and savings accounts. Others are dabbling in crypto custody or digital asset services as a way to cater to customer interest in cryptocurrencies, but in a safer, regulated way. Payment companies like Visa and MasterCard, which you might think of as traditional in some sense, are investing in fintech startups and blockchain networks to ensure they remain central in the payments flow of the future. Even if cards get replaced by blockchain tokens, they want to be involved. Insurance companies are using AI for faster claims processing and even for dynamic pricing of policies, say usage-based car insurance that tracks your driving behavior and sets premiums accordingly. Wealth management firms are using data analytics to better understand client needs and provide more tailored advice. The big picture is that institutions are integrating these innovations to become more efficient, customer-centric, and to open new lines of business. Real-world institutional example. One clear example of adaptation is J.P. Morgan Chase, one of the largest banks. They've invested heavily in technology. Their tech budget is over $12 billion annually, comparable to some big tech firms. They created their own blockchain platform, Onyx, to handle interbank payments, and even launched JPM Coin for internal transfers between corporate clients, demonstrating how a very traditional bank can pioneer using blockchain for real use cases. Another example is Goldman Sachs, which traditionally was an investment bank with no consumer business. They launched Marcus, a digital consumer banking arm, and partnered with Apple for the Apple Card, as we discussed. This shows how even Wall Street firms are going direct to consumers through technology and partnerships. Ecosystem building. We also see a trend of banks and fintechs creating ecosystems. For instance, some banks have app marketplaces where they allow third-party fintech apps to connect to the bank with open banking and offer their services to the bank's customers. Instead of fearing customers might use other apps, the bank curates a selection and maybe earns a referral fee or just benefits from increased customer engagement. This platform model, being the center of a range of financial services, whether or not the bank builds them all, is something a few progressive banks are trying. In summary, financial institutions are not static in the face of these trends. They are responding in multiple ways, modernizing their tech, collaborating with fintechs, and even emulating fintech practices. The end goal is to remain relevant and profitable in a changing landscape. Many institutions have slogans now about being digital first or technology companies with banking licenses, which shows the mindset shift. For consumers, this institutional evolution is beneficial because it means even the big established players are working to deliver faster, cheaper, and better services to keep up with the competition. When your longtime bank suddenly offers a slick new mobile app or a fee-free account with perks, that's the competitive pressure from fintech at work. Likewise, when a fintech startup seeks a bank partner to ensure your deposits are FDIC insured, that's recognition that banks bring stability and trust. We're really seeing a blending of strengths, institutional trust and scale merging with fintech agility and innovation. The real-world effect is that the lines between a bank and a fintech and a tech company offering finance are all blurring. In the future, you might care less about the label and more about the service. Is it meeting your needs securely and efficiently? If yes, then whether it's provided by a 150-year-old bank or a 5-year-old startup or a partnership of both won't matter much to you. And that is exactly the scenario that's unfolding. Challenges ahead. While the future of financial services looks bright and exciting, thanks to these innovations, it's not without significant challenges. As we wrap up our analysis, we need to address the hurdles and concerns that come along with these trends. It's important to have a balanced view. For all the benefits, there are real issues of trust, regulation, and risk that the industry and we as consumers must navigate. Let's discuss some of the major challenges on the horizon. Building and maintaining trust. Trust is the bedrock of finance. With so many new players, fintech startups, big tech companies, entering the fray and new technologies, AI, blockchain, operating behind the scenes, consumers might feel uneasy. Convincing people that these new systems are reliable and safe is a big task. For instance, even though neobanks offer convenient services, a large portion of consumers still prefer the reassurance of traditional banks with physical branches, around 83% in one survey. That highlights a trust gap that digital-only providers need to overcome. If something goes wrong, say a payment app has an outage and you can't access your money for a day, that can severely shake user confidence. Fintechs and incumbents alike will need to continually earn trust by providing reliable service, transparent policies, and responsive customer support. Yes, even if it's via chat, it needs to solve problems promptly. One advantage traditional banks still hold is their perceived stability and regulatory oversight. Newer services need to match that sense of security. Regulatory and compliance challenges. Financial services are heavily regulated for good reason. They deal with people's livelihoods and the economy at large. Innovations often outpace the regulations, creating gray areas and uncertainty. Regulators around the world are grappling with how to oversee things like crypto assets, AI-driven decision-making, and open banking data sharing. Striking the right balance is tricky. Regulate too tightly, and you might stifle beneficial innovation. Regulate too loosely, and consumers could be exposed to harm or the financial system to new risks. Take AI underwriting as an example. If a loan algorithm inadvertently discriminates against a certain group, how do we detect and correct that? There are regulations, like fair lending laws in the US, that forbid biased lending, but auditing a black box AI for compliance is a challenge regulators are now tackling. They may require AI models to be explainable and tested for bias. This is a challenge for the industry too, ensuring that the tech we deploy is ethical and fair. Open banking and data privacy are another area. Regulators need to ensure that data sharing is truly consensual and secure. Europe set a precedent with GDPR, data protection law, and PSD2, open banking law, working in tandem, giving consumers rights over their data while forcing providers to handle it carefully. Other countries are following suit. Still, as data flows increase, so do concerns about privacy. What if a fintech mishandles data or there's a leak? Strong oversight and possibly new regulations like data portability rights, open finance frameworks will be needed. Cryptocurrencies and blockchain pose regulatory questions too. Many financial authorities are trying to figure out how to integrate crypto into the mainstream regulatory perimeter to prevent fraud and protect investors without quashing the potential benefits. The collapse of some crypto platforms in recent years has only intensified calls for clear rules. In short, the regulatory landscape must evolve alongside innovation, and it's a delicate dance. Financial institutions often complain about regulatory burden, but at the same time, sensible regulation can build trust in new services. For example, having fintechs get licensed or meet certain standards can reassure customers and investors. The challenge is ensuring regulations keep up with the pace of change, which is why we now see initiatives like regulatory sandboxes, where companies can pilot new ideas under supervision to inform better rulemaking. Security and fraud risks. We've covered cybersecurity improvements, but it remains a constant challenge. As systems get more interconnected, open APIs, multiple third-party providers in the mix for one service, the potential attack surface for hackers can increase. A chain is only as strong as its weakest link. A small fintech app might not have as robust security as a big bank, but if it's connected to the bank via open banking, a breach in one could affect the other. This means all participants in the ecosystem need to uphold strong security standards. It's a challenge to ensure uniform security practices across a diverse industry. Fraudsters are also getting more sophisticated. We see waves of phishing scams, social engineering attacks, where criminals trick people into giving up login codes, etc., and even emerging threats like deepfakes that could mimic a person's voice to authorize a transfer. The industry must continuously innovate in fraud prevention. For instance, with more real-time payments, which are great for consumers, there's also less room to cancel a fraudulent transaction after the fact. So fraud detection has to be instant and accurate. There's an arms race going on between fraudsters and security teams. Identity theft remains a major issue. While digital identity tools are improving, criminals also adapt. If biometrics become common, they look for ways to spoof fingerprints or hack databases of biometric data. The recent stats we cited, tens of billions lost to identity fraud, show the magnitude. This challenge is not going away. If anything, the more we digitize, the more vigilant we must be. Moreover, consider systemic risks. A cyber attack not just on one bank, but on critical infrastructure like payment networks or credit bureau databases. Those could have far-reaching impacts. This is why we often hear bank executives say their number one worry is cybersecurity. Expect significant ongoing effort and investment industry-wide to counter these threats. It's a challenge that essentially never ends, because security is not a destination, but a journey of staying ahead of bad actors. Keeping finance human and inclusive. As we embrace automation and digital everything, there's a softer challenge, ensuring we don't lose the human touch where it's needed and that we don't leave segments of society behind. Not everyone is tech savvy or comfortable with an all-digital financial life. There are elderly customers, or those with disabilities, or simply people in areas with limited internet access, who might struggle if everything goes online. Financial inclusion isn't just about having an account. It's also about being able to effectively use it. If banks close too many branches too fast, some communities might suffer. So, the challenge is to implement new tech while providing alternatives or assistance for those who need it. This could mean keeping some form of customer service hotline or community education on digital finance, or designing apps with accessibility in mind, larger text options, support for screen readers, etc. There's also the emotional aspect of finance. People often want reassurance from a human for big decisions, like taking a mortgage or planning for retirement. Robo-advisors are great for many tasks, but some clients will always value human financial advisors for their empathy and nuanced understanding. The industry's challenge is to integrate the two. Use technology for efficiency, but keep humans in the loop for empathy and trust. The term bionic advisor gets thrown around, meaning a combination of human and machine working together. That's likely the model that will prevail in many areas. Managing technological risks and dependency. As financial institutions lean on tech firms, cloud providers like Amazon or Microsoft, fintech vendors, etc., there's a dependency risk. If a major cloud service goes down, it could potentially disrupt many banks at once. These are new kinds of risks regulators and banks are examining: concentration risk in technology providers. Ensuring resilience is a challenge. It means having backups and contingency plans if one service fails. In the past, banks worried about bank runs. Now they also worry about server downtime. The good news is that modern infrastructure can be very robust. But outages do happen. We've seen occasional payment network outages or trading platform glitches. Another subtle risk: as AI models make more decisions, there's a risk of model errors or unforeseen behaviors. Who is accountable if an AI denies someone credit wrongly, or if a trading algorithm misbehaves and causes losses? Firms need strong governance around their tech, monitoring, kill switches for algorithms, and accountability frameworks. It's a challenge to create these when the tech is new, but it's an active area of development. Regulatory coordination and global consistency. Finance is global, but regulations are national or regional at best. Innovation moves fast across borders. For example, a fintech in one country can quickly have users sign up from another. This sometimes creates loopholes or inconsistent protections. A challenge ahead is greater coordination among regulators internationally to handle things like cross-border payments, fintech operations in multiple jurisdictions, and so on. We're seeing steps in this direction: forums where regulators share information or alignment on standards, like Basel III rules for banks globally. But for fintech and digital finance, the frameworks are still catching up. An internationally agreed approach to, say, crypto or digital identity could help make adoption safer and smoother everywhere. Getting dozens of countries to agree is no small challenge, though. Adapting workforce and culture. From the industry side, there's also the challenge of transforming the workforce. Banks need more tech talent, and bank employees need to learn new skills or roles as automation takes over rote tasks. This cultural shift is significant. Imagine a bank operations team that for decades did manual processing, now having to oversee AI systems doing it. There can be resistance or friction. Companies have to invest in retraining staff, hiring the right talent, competing with Silicon Valley for data scientists, for instance, and fostering a culture of innovation rather than one that says, "We've always done it this way." This human factor challenge will determine which incumbents successfully reinvent themselves and which might fall behind. Consumer education and protection. Finally, with so many new options, and often complex ones, consumers face a challenge in understanding and making sound decisions. Financial literacy was already a concern. Now add layers like understanding algorithmic advice or knowing the implications of sharing your banking data with a third party. There's a risk some people might misuse new tools, like overborrow with easy credit access or get caught in crypto scams hoping for quick gains. Ensuring consumers are educated and that there are protections in place, like easy dispute resolution, clear disclosures, maybe even AI-driven alerts like, "We notice this investment is very risky, are you sure?" will be crucial. All these challenges are being actively worked on by industry, regulators, and consumer advocates. They don't diminish the potential of the innovations, but they remind us that progress comes with pitfalls to avoid. The encouraging thing is that awareness of these challenges is quite high, and collaboration to tackle them is at an all-time high too. Banks talk to fintechs about security best practices. Regulators talk to tech companies to understand new products, etc. The road ahead will involve refining technology and policies iteratively to address these issues. In essence, the future of financial services must be not only innovative, but also responsible. Achieving that will be an ongoing journey. As users, staying informed and cautious while embracing the positive changes is the best approach. As an industry, stakeholders need to keep the dialogue open and put the customer's interests at the center of these developments. Wrap up. As we conclude today's discussion on the future of financial services, I find myself both excited and reflective. We've covered a lot of ground, from fintech disruptors and AI algorithms to blockchain networks and beyond, painting a picture of an industry in dynamic evolution. It's clear that the way we bank, invest, save, and transact is changing rapidly, largely for the better. Convenience and personalization are rising. Barriers and frictions are falling. Financial services in the coming years will likely be almost unrecognizable compared to a generation ago, as digital and intelligent tools become the norm. However, it's also clear that certain principles remain timeless. Trust, security, and sound financial management will always be fundamental, no matter the technology at play. In many ways, the innovations we discussed aim to reinforce those principles by making finance more inclusive, transparent, and efficient, even as they introduce new questions for us to consider. The future will be about balancing high-tech with high-touch, where it counts, and ensuring that this brave new financial world is navigable and beneficial for everyone, not just the tech-savvy or affluent. Now, since this is the season finale, allow me to take a moment to reflect on Season 1 of Mastering Finance with Dean Tellone. Over the course of 15 episodes, we've journeyed through the essentials of personal finance and the complexities of the financial industry. We talked about budgeting, investing basics, economic trends, risk management, and more, laying a strong foundation. And today, we capped it off by looking ahead at how those fundamentals will be applied in an era of fintech apps, AI-driven services, and global digital connectivity. My hope is that each episode, including this one, has left you with actionable insights and a clearer understanding of the financial world around you. I want to thank each and every listener for joining me on this journey. Your time and trust mean a lot. The engagement, questions, and feedback I've received from you have been incredibly rewarding and have often shaped the content of the show. It's been a two-way street of learning, and I'm grateful for that. As we close Season 1, one might wonder, what's next? While this is a wrap-up for now, it's certainly not the end of Mastering Finance. The world of finance never stands still. As we've discussed, it's arguably changing faster than ever. There are always new topics to explore, new trends emerging. Perhaps by next season, we'll be talking about developments that aren't even on the radar today, and new questions to answer. So, I'm excited to say that this finale is really more of a see you soon. We're wrapping up this season, but already looking ahead to Season 2 and beyond. In the meantime, I encourage you to stay connected. Follow our podcast feed or my social channels if you haven't already, so you'll be notified when the next season or new content drops. Feel free to revisit earlier episodes or share them with friends or family who might benefit. The lessons of Season 1 are evergreen. And of course, keep an eye on the financial landscape yourself. Maybe try out a new fintech app we talked about, or read up on that AI trend in banking, or simply take a moment to assess your own financial plan with a future-oriented mindset. The best way to benefit from these innovations is to engage with them thoughtfully. As we end today's episode, let's recap the big takeaway. The future of financial services is bright, tech-driven, and full of opportunities. We'll see more empowerment of individuals, more inclusion of those left out, and more creative solutions to age-old financial problems. There will be bumps along the way, but I'm optimistic that industry leaders, regulators, and consumers are increasingly working hand in hand to shape a positive future. After all, finance at its core is about enabling people to achieve their goals and secure their well-being. That mission remains, even as the tools evolve. Thank you once again for listening to Mastering Finance with Dean Tellone. It's been a pleasure guiding you through this season's topics. Stay tuned for what's to come. I'm truly excited about Season 2 and hope you are too. Until next time, take care, stay financially savvy, and remember, the world of finance is always mastering new tricks, and together, so can you. Here's to the future of finance and to your financial future. Thank you and goodbye for now.